Hello, and welcome to this inaugural podcast on all matters financial markets, brought to you by the Good Money Guide and Pepperstone, who are kindly sponsoring this with me, Michael Hewson, and my guest, Michael Brown of Pepperstone. We'll be talking about the reasons behind the moves in financial markets, looking back at the week just gone, as well as looking ahead to the upcoming week, where Michael and I will be hoping to inform, explain, hopefully educate, and discuss the topics that matter. We'll try not to swear, I can't promise, but you never know. But first of all, let me tell you a bit about me. I've been working in and around financial markets now for over 30 years, which dates me slightly, longer than Michael's been alive, in essence. Me sort of nodding in agreement there. As a trader, educator, and analyst with qualifications from the Society of Technical Analysis and Certified Financial Technician, or as Michael likes to describe it, as the Society of Painting Crayons, so on charts and what have you. Anyway, I can be found on social media, on X, LinkedIn, and I've been recognised for my contributions to analysis in City AM, nominated twice in the category for Analyst of the Year awards in 2019 and 2021. I didn't win, but hey, it's nice to be nominated, and helping to win Best In-House Analysis category 4 years in a row in my previous role, so at the Professional Traders Awards. So on that note, I will pass you over to Michael so he can introduce himself.
Thank you, mate. I mean, you've got more trophies in your cabinet there than Spurs have, haven't you? And they've been going for a hell of a lot longer than you in the markets.
Well, this is very true, mate.
There we go. We've alienated
one Arsenal fan to another.
Exactly.
No skin in the game there at all.
Alienated half our audience already.
Well,
Thank you, mate.
I don't know about half, maybe an eighth.
Well, yeah, if we're being generous. My name is Mike Brown. I'm the Senior Research Strategist here at Pepperstone. I've been in the markets it's getting on for a decade now, which sounds slightly crazy, but it really is that long. As Michael said, take a slightly skeptical view of technical analysis, tending to focus much more on the macro and the top-down view of exactly what's going on. And very much looking forward to getting cracking with this podcast with my good friend and seeing what insights and value we can hopefully add.
I think this is the point. I think one of the good things about hopefully this podcast will be that it'll be more pub-side chat than fireside chat. So it'll be fairly informal. We'll discuss the topics of the day, and hopefully, as I say, try and give some sort of direction with respect to what markets might do over the course of the next few months. But before we get started with the business end of this podcast, I have to do a little bit of housekeeping, and that is a disclaimer which I'm going to read out for you. The information provided here in this podcast, whether it's from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers, listeners of this content to seek their own advice. Spread bets and CFDs are complex leveraged instruments and come with a high risk of losing money rapidly due to leverage. 75.1% of retail investors' accounts lose money when trading spread bets and CFDs with this provider. So, with that out of the way, why don't we get cracking, Michael? And let's talk about Mr. Bailey, Governor of the Bank of England.
I thought you were going to go with the US election there. Well, you've thrown me a curveball already.
I'm going to segue into that. I mean, if you want me to start with the US election, I'm more than happy to, because I certainly think there's been an awful lot of what I would call pearl clutching from some members of the mainstream media about the outcome of Trump's surprise, and I'm using inverted commas for those of you who are just listening, for Trump's what looks like a landslide win, and really a bloody nose for the pollsters, if I may be so bold. Yet another one they've got wrong.
Yeah, it really was. I mean, I think that's the thing that surprised me most is that, the convincing nature of the victory, not only in terms of Trump obviously winning the presidency, carrying all of the swing states, and the Republicans flipping control of the Senate and retaining control of the House as well. I mean, that's a pretty seismic electoral result and a massive rejection of the Democratic Party policies that they put forward during the election campaign. And I think it tees up a really interesting, certainly 2 years ahead until we get to the midterms in 2026, because pretty much whatever President Trump, as he now is going to become, wants to do, he can do. There are not going to be any constraints on that from the congressional or from the Senate at all.
Yeah, I think this is the one big difference, I think, from 2016 to 2020, where there was some what I would call restraining hand on his shoulder, if you
Hmm.
like, with respect to some of the policies that he could implement. But having said that, if he really wanted to do stuff, and he did then back in 2016, is he just signed an executive order and pushed them through that way. So there's concern about tariffs,
Hmm.
trade war. We've heard this song before. We heard it in 2016. The sky didn't fall in, and you're getting all these warnings again. And yet, I can't help thinking that this is straight out of the Trump playbook. Basically, walk loudly, talk loudly with a big stick, and hopefully you'll get some form of quid pro quo, and the worst case scenario may not play out. And I think the same thing is going to happen again. And I think that's probably why we've seen the dollar gains that we saw yesterday start to come back as the markets start to temper their expectations about what Trump says he'll do and what he will do.
Yeah, I think you're exactly right. Although the other thing I would just add on that is there's been a lot of sort of conjecture recently around, oh, Trump's back, it means increased volatility, political volatility and instability. And actually, I'm not sure that's particularly true, because if you look back at 2016 to 2020, Trump tended to go by a sort of policy of saying something and then going and doing that. And I know that's an unfamiliar concept to quite a few politicians out there, but in many ways, it makes it a lot simpler, as certainly as financial market participants, it makes it a hell of a lot simpler to price risk. You've got a chap who's run a campaign saying, we're going to throw tariffs on imports, we're going to go after China, et cetera, et cetera, et cetera. What's going to happen on the inauguration day? He's going to sign an executive order putting tariffs in place. We know we have to price that straight away, and that's exactly what the market went and did. So, in many respects, I think actually, yes, things are going to be a little bit interesting, should we say, watching from the outside looking in. But at the same time, it should actually be relatively straightforward to get a view on what he's likely to do. Tariffs and tax cuts are the first two policy moves.
Yeah, I think the tax cuts is a particularly interesting one, given the fact that they sunset the 2017 tax cuts that he brought in his first term. They sunset next year. And he has a decision to make with respect to whether or not to roll them over, because if he doesn't, then you could see a big tax shock hit the US economy. And I can't for one moment think he's going to let that happen.
No, absolutely not. I think it's all but guaranteed that he rolls those over. I guess the question is, does he go and add more on top of that? Is really what you need to think about.
Yeah, I think that's the biggest concern. I think, it's the fiscal deficit the US government is currently running. But I don't think markets can see that as a particular problem until it is, because
Hmm.
ultimately the dollar is still the reserve currency. And as long as there's an appetite for US debt, then ultimately I think the US can go on for quite a long time before people start to question its fiscal sustainability.
Yeah, and I think that's the big difference between the US and pretty much anywhere else.
Mm.
And I was having this conversation with someone on Twitter this morning, or X, or whatever we're calling it now, is that the US issues the global reserve currency in the dollar, and it also has the safest government debt in the world in treasuries. Nowhere else has that privilege, as Rachel Reeves down in number 11 Downing Street is rather quickly finding out as the gilt market struggles to digest her budget.
Yeah, so this is what we term US exceptionalism, essentially.
Yeah.
Um, they're essentially the lender of last resort for the global economy, if you like. Whereas, the UK government is suddenly finding out the hard way that if markets lose confidence in your ability to raise taxes and grow your economy, they'll start to price that in. And we've certainly
Hmm.
seen that, I think, this week. In fact, this past few weeks since Labour got in, how yields have gone up. And yet the Bank of England has implemented 2 rate cuts since then, which doesn't really bode well, I think, for future rate cuts going forward. We've had Rachel Reeves' tweet today, and I think you posted a rather uh, a rather snidey comment on it that it's good news the Bank of England's cut interest rates. Well, yeah, not really, because mortgage rates are going the other direction. They're going up. It doesn't matter what the base rate's doing. You can cut base rates all you like, but the gilt market is pricing a completely different scenario, and that for me, I think, speaks volumes when we talk about the Bank of England having a base rate expectation of 3.7% by the end of next year. I really can't see that happening, given the data that we're going to be looking at next week. And I know we've segued slightly to the UK economy here, and we'll talk about that. But I think going back to the Trump thing, I think there's a wider issue at play here, and it regards net zero and the US economy. And for me, I think the reaction of those, solar providers and renewables stocks yesterday spoke volumes that he's going to pump an awful lot of taxpayers' dollars into drilling for new oil and gas, in stark contrast to what is happening here.
Yeah, that's very true. And I think the other thing to bear in mind is, just on a sort of more global level, is we're already dealing with the oil market in particular is demand is waning. The demand outlook for crude is not great. OPEC have actually just rolled over their supply cuts for another month, and they might extend them even further. And then come January 2025, to quote Trump himself, drill baby drill in the oil fields of the United States, a massive supply glut potentially coming into the market. So, I mean, I guess that's good news from an inflationary perspective, because if you do see greater supply, oil prices will roll over, and inflation should come lower along with that.
And I think that's one thing that Trump does get, essentially. What's the biggest cost to businesses when it comes to everyday trading? It's energy. Cheap energy, and ultimately your margins will improve, and essentially, hopefully, your profits improve, and you can afford to pay your staff more money. And it just surprises me the current government just doesn't get that. No one's saying that you shouldn't transition to net zero, but getting rid of oil and gas and not investing in oil and gas and having a longer lead time so that you can slowly change the blend between fossil fuels and renewables just seems to be economically illiterate. Anyway.
No, you're right, and of course, I don't want to turn this into a climate change podcast, but there was a day earlier, I think it might have been over the weekend, the UK was not producing any wind or any solar power. So if we shut down all the oil and all the gas,
Germany's the same.
Yeah.
And that's why they're in a manufacturing depression. If you look at the PMIs in Germany for manufacturing, they've been sub 50 for nearly 18 months, and sub 50 is essentially contraction territory.
Yes.
So, there are big issues that Europe has to contend with respect to energy prices. And it appears to me that the US is not only self-sufficient, but they're going to also throw more money at it. There is one fly in the ointment, though, and we'll talk about it a little bit, and that's Trump's attitude towards Iran, which could impact global supply chains for oil.
Yes.
And I think we really need to understand what he's going to do with respect to Iran. And I can't think that it's going to be any different to what he did in 2016, 2020, and basically re-implementing sanctions.
Well, that would be the initial guess. I suppose the other thing to watch on that one, and we've got Sky News on in the background there. They're just talking about this now. Who might be in the cabinet? In terms of the Secretary of State and the National Security Advisor. If he picks hawkish foreign policy thinkers, particularly Iranian hawks towards Iran in those positions, then the market might start to get a little bit more jittery on that front.
Yeah, indeed. Okay, well, later tonight we've got the Federal Reserve. So unfortunately, we don't have the benefit of what they are going to do later this evening. And in the context of Trump, obviously, Jay Powell now has a very difficult balancing act when it comes to his press conference later tonight, because ultimately he's looking at the inflation projections and the dot plot projections from September. Well, now they're completely out the window. They're not worth anything because US bond markets have repriced now in terms of what to expect from the US economy. it's still fairly resilient, notwithstanding obviously last week's really poor payrolls number. But I think a large part of that was probably down to hurricanes Milton and
Yeah.
Helene, and consequently you could see a pickup as we move forward. So, I think in terms of the labour market, it's still in fairly decent shape, and that for me I think means that the potential for further rate cuts is again limited, I think, by the macroeconomic environment and obviously concerns about rising inflation.
Yeah, I would agree to an extent. I mean, I appreciate that listeners are going to hear this after Powell has spoken, and that this may age terribly. But I would actually say that tonight is probably one of the easier press conferences Powell has had, because any question on politics, he's never going to answer it. You know, whether we're just after an election or we're, 4 years until the next election, he's just never going to give an answer to it. And that's all the questions are going to be on. Now, if you kind of get yourself in the mind of a policymaker, they know that this is on the horizon. They know that Trump is coming in. They know that the policies are likely to be reflationary, but they can't really react to that now because they don't know exactly what those policies are going to be. So they can't put that impact into their models. They can't put it into their forecasts or the rest of it. So you're kind of left in this sort of no man's land where all they can do is effectively do what they've already communicated, which is a 25 basis point cut, and then just kind of say, well, we will stay data dependent and be guided by that data. And then when we have a bit more clarity on what will happen, that's then thrown into the models, and then you get a policy response to it. So I think in terms of a Trump impact on monetary policy, you're probably looking at the first Fed meeting next year, which I think is late January. That's when you might get a little bit more of a sort of explicit remark. But I do agree with you. I mean, I think at the crux of it, you look at what Trump wants to do. I use the word reflation. What are we looking at there? We're looking at higher or stronger economic growth and a move higher in inflation. So putting those two things together, naturally, you would say, all else being equal, the policy stance doesn't need to become quite as loose as they were perhaps previously planning.
Certainly, the reaction of the stock market suggests that they're fairly comfortable with rates at their current levels. And ultimately, I think, for me, I think one more rate cut this year, well, essentially tonight, 25 basis points tonight, which is what is being predicted. That's it until next year. Same as the Bank of England.
Oh, okay. I still think the Fed will go in December as well.
Do you? Okay.
Yeah.
Well, there we go. We have a difference of opinion, which is always good.
I will warn listeners that whenever we've had these little bets or discussions in the past, I think Michael's been right 99% of the time at this point.
Listen, I'm wrong all the time. I'm not afraid to admit when I'm wrong. And I think this is one of the first rule of investing or trading. Don't get wedded to a particular idea or a particular trade, because ultimately, if you've changed your mind about it, get out of it, move on. Trades or investment opportunities are like buses. You may not see one for a while and then three come along at once. There'll always be another one. You just might have to wait a while for it. But don't get wedded to a particular idea. If circumstances change, as Keynes said, when the facts change, I change my mind.
Yeah,
and I change
absolutely.
My mind. Not probably as often as some of these merchant banks do, which is with every single piece of data. But it's about the underlying macro trend that's in place.
Yes.
And essentially stick with that. But I certainly think the dollar is probably going to remain fairly strong for the time being, and that will present a problem for Trump going forward.
I think so.
He doesn't like a strong dollar.
No, he doesn't. But what else are you going to buy in the FX?
Yeah, this is very true. This is very true, and that is going to be one of the problems that not only Trump will have, but also Powell will have. And I think Powell and Trump have clashed before, and I think one of the things over the course of the next 4 years will be the dynamic between the two, because I don't think Powell will stay on as chair. Trump will replace him in 2026 because his chairmanship comes up for renewal in 2026. So there could well be a new Fed chair, in which case, then it's a question of what will the Fed look like after 2026. I think it's May 2026.
It is, yeah. And I think that is going to be interesting, who replaces Powell. A number of names have been sort of rumoured around that one. I think Kevin Hassett, who was the one of the Trump's economic advisors last time around, a chap called Kevin Warsh as well, who's previously been on the board of the Fed. But we're way too early to
We are
seriously
for
get
that.
into
But I
that
mean, that's
now.
not, people are going to start talking about it.
Oh, absolutely, absolutely. And I think the interesting thing on that though is just to consider when Trump was criticizing Powell previously, we were dealing with a Fed that was in the middle of a tightening cycle.
Mm.
2016, 17, 18, they were looking to raise rates and trim the balance sheet. We're now dealing with a Fed that's doing the opposite. They're actually looking to lower rates and slow the pace of balance sheet runoff, if not expand it again at some point in the future. So it is a little bit of a different dynamic on that front.
Okay, well, I think we probably talked about that for quite long enough. Let's look at the UK. And obviously, we've seen Bank of England, Bailey's basically upped his inflation forecast for next year by 50 basis points, which is bad news. Certainly, I think in terms of where UK rates are likely to be. I'm just looking at my UK 5-year and 5-year gilt yield, and that's now down at 4.41%. So it's down modestly, but ultimately 4.4% when the base rate is 4.75% is probably still a little bit too high.
Yeah, and I think the message from the BOE today was, I would almost argue, a sort of resolutely hawkish one. You're seeing
Hawkish
central
cut.
banks. Yeah, absolutely. And I know that sounds like a bit of an oxymoron, but
Mm.
you look at the BOE's guidance and it was unchanged from what it has been, well, for pretty much the entirety of the year, saying they need to remain restrictive for sufficiently long to squeeze inflation out of the economy. They're going to take things gradually and they're going to take a meeting by meeting approach. There's certainly nothing in there that screams, faster or more sizable rate cuts from here on in. I think the most interesting thing for me from what the BOE said today was their forecast. You alluded to the inflation forecasts. They now don't see inflation coming below 2%, which is obviously the target, until 2027, which is when they see us coming down to 1.8%. Now, the way
It's
the BOE
1.7% now, though, isn't it?
Yes, but a lot of that is driven by energy, which
Yeah.
is going to fall out of the figures. So we're going to go up to sort of 2.5, 2.6, and then slowly come back down. This is the BOE's profile, of course, anyway. So I think that the interesting thing to remember is these forecasts are based on the path of interest rates that markets price. So what the BOE is saying that if we do what the market is currently expecting us to do, it will take us 3 years to get inflation back to target. The implication being markets, you're pricing too much in terms of policy easing, or at least they were in the back end of October when these forecasts were put together.
Yeah, indeed. And also, I mean, the Bank of England's job hasn't been made any easier by recent public sector pay settlements either. You look at the doctors, you look at the train drivers, and what have you, and essentially, it's costing the government around an extra £10 billion, over the course of the Parliament. So, that's going to add to wage inflation, and we've got data for that out due next week along with unemployment. So, I'm looking at my notes here, and you've got headline inflation, which is headline CPI, which is at 1.7%. I think that's due out the week after next.
Yeah, it is.
The latest numbers for that. But the wages data, if you look at the wages data, that's subsided quite considerably from the start of the year when it was at 6.5%. It's now 3.8%. But I can't see it going much lower than that. But as a consequence of these public sector pay settlements, that's going to be a problem. Core CPI is also higher because that doesn't have energy prices in. That's at 3.2%, and then you've got service sector inflation, which is 3.9%. And all of those particular pieces of inflation probably affect people probably more than headline CPI. That is going to be a problem, and that for me suggests that the scope for cutting rates, while there, is probably not as big as it was 2 or 3 months ago.
Yeah, I would strongly agree with that. And actually, there's other inflationary implications that are going to come from the fiscal side of things. Pretty much every company in the land now has a much higher national insurance bill that they need to pay from April. Some of the big supermarkets in the UK, we heard from Marks and Spencer's yesterday, they were saying it's going to cost them 120 million extra a year. Sainsbury's this morning saying it's going to cost them 140 million extra a year. Now, they're not just going to magic that money up by shaking a tree. That's either going to come from lower pay increases to their workers, or it's going to come from raising the prices that we all pay when we go and do our weekly shop in order for them to cover that bill. And of course, that is then going to feed into the CPI metrics that you just mentioned, mate.
There's a third option there, Michael, which you haven't mentioned.
Well,
It's basically letting staff go,
exactly.
right, and replacing them with the bane of a lot of people's lives, self-service checkouts. Because a
Oh, God.
computer doesn't cost anywhere near as much money to pay as a member of staff.
You don't pay national insurance on a computer either, do
Exactly.
you?
And they've lowered the national insurance threshold for companies from 9,100 to
Hmm.
£5,000 on
Yeah,
employees. So it's not so much the increase from 13.8% to 15%,
it's a
it's
double
the
whammy, isn't it?
lowering of the threshold which companies have to pay national insurance on behalf of their staff. For me, it's just indescribably economically illiterate. And
Yeah.
ultimately, I think that's why I'll also be looking at the unemployment figures because they've fallen from a peak of 4.4% in April to 4.1%.
Oh,
Now, I know the ONS has problems basically saying where it thinks the unemployment rate is. But for me, irrespective of whether or not they've got problems with it, increased automation is likely to be a consequence of these recent changes by the government.
I think you're absolutely right. I think you are spot on in terms of increased automation. We were on that journey anyway,
Yeah,
particularly in
this is going to
in a lot of
accelerate.
these, yeah, exactly, in a lot of these service sector jobs. I would just, I know you sort of glossed over it there. I would just say we do need a bit of a health warning on the unemployment data.
Yeah, I mean, I did
Even
mention it, and I know you're skeptical about it.
Well, even the ONS themselves, who
Yeah,
pull the number together, then put a note on the survey saying all the other metrics of the UK labour market produced by third parties say the opposite to what our data says.
yeah.
So yeah, I do think that perhaps the labour market isn't quite as tight as the unemployment rate would indicate. But yeah, it does seem completely economically illiterate, to be completely honest with you. And the bigger concern is, all of these policies have come in with the aim of, going for growth, and GDP is not projected to grow north of 2% at any point in the next 5 years.
Glad you brought that up because we've got third quarter GDP next week
There
as
we go.
well.
It's almost like we
So,
we planned this.
I know. So that's due out on the 14th, a week today, and we're going to get the first iteration of third quarter GDP, which goes from July to September. Well, the first half of the year was fairly decent. We saw growth of 0.5, 0.6% in the first quarter and 0.5% in the second quarter.
Hmm.
Now, that does come with a health warning in the context of the fact that we had a weekend to 2023. So you've got what I would call a bit of a half-year bounce back, falling inflation, and obviously that helped, I think, put a little bit more money in people's pockets. But you obviously had the riots in July. You've had the government talking the economy down, talking about fiscal black holes of 20 billion, 30 billion, 40 billion, or whatever, imaginary black holes, if you like. I don't know. But I mean, I would argue that if you've got a fiscal black hole, you don't chuck 22 billion at carbon capture and you don't chuck 10 billion at public sector workers because you can't afford it. So
Exactly.
for me, it's politics, this. And in this type of politics, they've talked the economy down. And I think that will be reflected in the GDP numbers. Maybe by not, maybe by not as much as we think, but certainly I think we can expect to see something in the region of about zero point 0.1 or zero point 0.2, a slowing of
Yeah.
GDP, which is essentially not what you want to see. You want to see, zero point 0.5, zero point 0.6. And I'm struggling with that. I've got to say I'm struggling with that. You saw that impacted in retail sales as well in July, a decline of
Hmm.
1.5% in July.
Yeah. I think growth is going to be pretty anemic in the third quarter. I mean, you mentioned the government sort of talking the economy down, that did have an impact. You
Mm.
look at the consumer and the business confidence numbers that came out in August and particularly in September as those pre-budget nerves really started to set in, and both were falling off a cliff,
Mm.
which does have a real follow-through impact into spending and investment. The other thing to consider, I know people probably chuckle at this, but think back to how many sunny days did we have during the summer? I reckon I can probably count them on one hand. So what's that going to do to
To
retail
be fair, you
sales
have
and
been
spending?
indoors for most of the summer. I've been outdoors, so
Well, I
actually
have, that's
quite a
true.
lot.
That is very true. But it wasn't the best summer, and that is going to
No.
depress spending, not only in terms of retail sales, things like beer and barbecues and all that good
Mm.
stuff, but also in the hospitality sector. If
Mm.
it's pelting down with rain outside, you're not exactly going to go and sit in a beer garden, and that's just another headwind for the economy to have dealt with. So yeah, I don't think that the GDP data is going to be as optimistic as the government would like for their
Mm.
first quarter in power.
I think one thing we do underestimate, though, is the resilience of the UK consumer as a whole. They are fairly resilient, and ultimately they will find a way to sort of at least try and make life bearable. And I think
Hmm.
the decline that we've seen in fuel prices will have helped, I think, keep the economy from, slipping back significantly from what
Hmm.
we saw in the first half. But now we're heading into the end of the year. I think there's bigger challenges ahead, and obviously energy price caps, what have you,
Yeah.
consumer confidence, retail sales. We did see a pickup in August and September. So things aren't as bad as perhaps they could be. But ultimately, I think as we look towards next week, I'll be very interested to see some of the trends that come out of that data and whether
Hmm.
or not they offer an insight as to what's coming over the course of the rest of the year.
Yes. No, I think I will be as well.
Cool. Okay. We've got US CPI next week as well as along with US retail sales. Don't think we really need to sort of say too much about them. Essentially, US inflation isn't an issue at the moment for the Federal Reserve. It's more about forward projections as to how quickly that will remain in and around that 2.5% area, which is essentially the level that they're targeting. And let's not forget the Fed has a dual mandate. It's unemployment and CPI. So it's not just focused on inflation, it is focused on the unemployment rate. And even though it is higher now than it was 12 months ago when it was about 3.5%, it's still fairly low on a historical basis, around about 4.1, 4.2%. So,
And sorry to jump in, not only low on a historical basis, but also that 4.1% that you mentioned was for October. The
mm,
Fed's year-end forecast is for 4.4 in the
mm.
September economic forecast. So
Wow,
it is
that's interesting.
low, and it's better than where the Fed expected it to be.
Mm. Big question is whether or not it will go up by the 0.3 percentage points that the Fed thinks it will. History suggests it
Well,
won't.
you're going to need a pretty seismic economic event for that to happen in a couple of months, I think.
Yeah, and we're in that sort of twilight period now between Biden handing over the reins to Trump.
Yeah.
So I can't imagine anything significant will happen, geopolitical concerns notwithstanding, and black swans. So
Yes.
and you can never predict them anyway. So
No. And,
you know,
and let's not tempt fate, mate. Come
no, let's not tempt fate.
on.
Okay, so that's the macro for next week. We also said that we'd look at company earnings. Um, we've seen a couple of big movers today. I noticed that BT Group has had a bit of a nightmare today. Is down around about 6% because it missed on its revenue outlook and guided lower on its outlook for 2025. What was interesting about, I think, this particular one was that it could be a bellwether for Vodafone's results, which are coming up next week, and whose shares are recently traded at the lowest level since 1997,
Bloody hell.
earlier this year. So I think Vodafone's results, first half, are due on Monday. No, the 12th. It's the 12th. Yeah. So
Tuesday, yeah.
Tuesday. So I think for me, this is a very, very interesting one because ultimately, another new CEO, Margarita Delaval, finally agreed a €5 billion deal to sell its Spanish business earlier this year, which completed in May. There's been chatter about selling off the Italian business constantly over
Hmm.
the course of the past couple of years to Iliad. And once again, I think it was about 10 or 11 billion euros. I don't know why that they seem very reluctant to part with this business. But there is some chatter now that they could be forced to by Italian regulators to sell off some of those Italian assets as a
Mm.
consequence of its recent tie-up, €8 billion tie-up with Swisscom. So that's going to be interesting. It's also going to be interesting in the context of obviously the disappointing numbers that we saw from BT today. So
Mm.
Vodafone's one to keep an eye out for. How much more downside is there really when the shares are at the lowest level since 1997? And the big question is, can they essentially turn the share price around? I've been watching Vodafone for years, and it's just one misstep after another.
Yeah. Well, I would say two things there. One is, just because something's fallen a long way, it doesn't mean it can't fall further because things do seem pretty ropey there. The other one is you talked about regulatory issues in Italy. They're having plenty of those here in the UK as well with this proposed tie-up with Three,
Hmm.
which seems like it might finally be getting through. But you certainly wouldn't look at that as any sort of silver bullet to solve the ailing state of the business.
No, true, but then it would just give you three big players in the industry. Got Vodafone, EE, and O2.
Yeah, and
So
anyone who's been in London recently will know that mobile signal is already pretty ropey in the square mile, certainly.
mm,
So a lessening in the degree of competition is only going to make that worse, you'd imagine.
yeah, I mean, I think 5G. I think you know, as you rightly said. I mean, where I am right now, 5G coverage is pretty spotty. Hopefully, there will be some progress on that because earlier this year they signed a 10-year deal with Microsoft to integrate generative AI
Mm.
into their 5G services as it looks to take on EE and O2. So, hopefully that will generate, some improvement in terms of the rollout and the
Mm.
resilience of their network. But as I say, interesting on,
Well, I hope so. Yeah, I'm not sure it could get worse. So,
well, that is very true. That is very true. We've also got Burberry, first half numbers, having dropped out of the FTSE 100 in September. They've had an absolute shocker. The shares have
well,
lost over
you've stopped shopping there, mate, haven't you? So that
I
must be
thought it was
why.
you, mate.
I'm not sure checks and tartan are my style, to be
Oh,
honest.
that's right. Sorry, it's Gillettes from Millets.
Yeah, exactly.
But yeah, I mean, again, they've also changed their CEO. Latest incumbent is Joshua Schulman, whose CV includes Michael Kors and Coach. I think the slowdown in China and Asia hasn't really helped Burberry. It hasn't helped an awful lot of the luxury sector. I'm old enough to remember when LVMH was trading at record highs, Louis
Mm.
Vuitton, and their share price has struggled today. Hermes has struggled. They've all struggled, but Burberry, I think, has significant problems of its own. But having said that, there has been some chatter that there could be some takeover interest in Burberry. I mean, have you got anything to shed on that? Moncler, I think, was mentioned.
Oh, right. That's sort of uniting the brands that folk from Essex wear, that one. It makes sense, though, because when you look at any industry that is facing what seems now to be some sort of structural issue. I mean, as you said, it's not just luxury goods here in the UK. The luxury sector in Europe has taken a real battering
Mm.
recently. It's not surprising that those businesses look to sort of batten down the hatches and try to consolidate in order to protect their positions. So, certainly wouldn't be a surprise. And actually, the buying interest would be sort of circling given the state of the stock this year, dropped out of the FTSE as well, as you said.
Mm.
It wouldn't be particularly surprising to see a few people trying to snap up that brand. So, yeah, keen to see how that one plays out.
Yeah, I think that's one thing I have noticed in the years that I've been covering markets is that whenever a stock drops out of the FTSE 100, it rebounds.
Mm.
Have you noticed that?
Yeah,
So
absolutely.
sometimes, the headline is, oh, it's dropped out of the FTSE, it's been demoted, blah, 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 sell it, sell it, sell it. Markets have already got ahead of that.
Yeah.
And they've sold it because they know it's going out. Once it's out, and this is not investment advice, by the way, but I've
No.
noticed a trend that generally over time, the share price of that business tends to recover.
Yeah, and,
Um,
and actually, it's worth noting that and it's not just the FTSE, but really any index, when a stock does drop out of the index, generally the vast majority of people who are selling it are forced sellers.
mm,
Be it an index fund or an ETF
the
that is
tracker.
tracking the
Mm,
FTSE 100. If Burberry are dropped from the FTSE, then that ETF can no longer hold Burberry, and they
Mm.
sell it and buy whatever's replacing Burberry in the index. So actually, there's very few people out there, I would imagine, certainly those that I encountered, again, not any sort of advice, who would go, oh, I'm a long-term holder of the stock. I really believe in it. There's a headline that it's dropped out of an index. They're not immediately going to go, oh, I hate it now. I'm going to tear my whole investment thesis up. So there is a sort of mechanical reason behind that trend, I think.
Okay. All right, well, let's finish up with a US stock. I was going to talk about AstraZeneca, and certainly AstraZeneca shares have taken a bit of tumble in the past few days. They're due to report Q3 numbers on Tuesday, 2024, but they've been in the news for completely different reasons in the past couple of days, and that's because of not only some natural profit taking from record highs, but also the arrest in China of its head of China. Due to, I think it's part of an anti-corruption crackdown
Yes.
on allegations over the illegal importation and sale of cancer drug Imjudo. So it'll be very interesting to see how that pans out. I honestly can't see it unless something really bad has happened, impacting the overall trend for AstraZeneca, which has generally been fairly positive since it took over Alexion back in 2021 and basically boosted its expertise in rare diseases. But I think that's another one to keep an eye out for. See if they've got any comment to make about events
It
in
is,
China.
and I guess the worry is this a one-off, a sort of a bad apple who's got a
Mm.
bit rogue, or is this, as you alluded to, the start of a broader sort of trend or operation within the firm being uncovered, and the first of many that the Chinese authorities might start to take a look at. I think that's really what participants are going to focus squarely on there.
Okay, so let's finish off with Disney. Q4 24, its latest earnings numbers. I think this is particularly interesting given the fact that for quite some time Disney has been losing subscribers. I think it had a peak of around about 160 million subscribers back in 2022, 2023. It's now down to around about 140 million. An awful lot of them are in India. It was basically a loss leader, if you like, the streaming business to try and take
Yeah.
on Netflix, which remains the market leader. I think the key thing for me is in light of the price increases that we've seen in Disney Plus over the course of the past 12 months, is whether or not they've been able to stop that hemorrhaging of subscribers. But more importantly, what impact Hurricanes Milton and Helene had on its parks business in the third quarter, because there were all these headlines of flooding Disney World in Orlando, and whether they took a massive financial hit there.
Yeah, no, I think you're right. I mean, I think just streaming in general. We were talking about consolidation earlier on. I don't think we're going to see any consolidation, but there's so many streaming platforms out there at the moment that it's not surprising, particularly as labor markets begin to loosen, inflation begins to bite. It's not overly surprising that consumers are out there going, do I need 5 different streaming platforms which by and large show similar things, particularly when the platform providers are hiking their prices. And I question whether, particularly for Disney, does it become a bit of a vicious cycle where they're losing subs, so they raise prices because obviously they want revenues to stay the same or even grow, which means more subscribers are lost, which means they raise prices further, and you just end up in this sort of endless cycle of woe. So yeah, I do wonder whether we're going to get any more clarity on that. I think the parks point is an interesting one. Obviously, a lot of that will be covered and be insured, you would expect. But the degree to which there may be a hit as they carry out repairs, I think, is really what you're looking for, the charge that they may take on that side of things.
Yeah, I think in the last earnings report, they talked about higher costs when it comes to wages and the like, and that impacted their third quarter numbers. So their share price is still below $100. So it's near the lows that it's been for quite some time. So I think for me, it's less about what's happened in the last quarter. What are their projections for 2025?
Yeah.
Cool. Okay. Well, I think that's pretty much it. I think we've covered a lot in what looks like nearly 46 minutes now. So hopefully
Yes.
you've been able to stay with us for that long. There's a couple of items on the Good Money Guide website that might be of particular interest to some subscribers. A very good talk on the homepage, goodmoneyguide.com/news, from the head of the London Stock Exchange. Charlie Walker, where he gave a speech at the London Investor Show last Friday about the prospects for the London Stock Exchange and investment in the UK. I think that's well worth a listen. If you've got any questions for me and Michael, drop me a line at Michael at goodmoneyguide.com.
He's new. He hasn't learned his email address yet.
And as I say, if you've got any comments, suggestions for me and Michael in terms of what to cover in the next podcast, feel free to drop us a line. Always happy to hear what you have to say, what we could do different, or whether or not we just want to keep the format the same. Anyway, thank you very much for listening, everyone.